What's up, YouTube? It's Joe Cachapalia sitting on the couch making some money investing in fractional real estate online, as usual. Today, I just want to talk about Mogul's latest pad split. It's the Rudolph. This is a 9-bedroom, 3-bathroom co-living property in Mesa, Arizona. This is the one that they launched during their webinar on Thursday. You can see there's already only $100,000 remaining to invest in this one. I think that means, their total offering was $285. So almost 2/3 sold out already, as we've seen their pad splits go very quickly. This one's very close to the Roads, which is a property that I bought very early on. It was the second property I bought on Mogul, and it was a 10-bedroom, 3-bath pad split. So one extra bedroom, same amount of bathrooms, about 300 square feet bigger. So that's kind of interesting. It's only one more bedroom with 300 square feet, but it's probably just about how the common areas are used or the size of the bedrooms or whatnot. This is another one of the properties where they have contracted with the seller to renovate the property, put it on pad split, furnish it, and then we're going to take it over, then we're going to close on it once that's done. We haven't seen one yet go live that they've done that with. The Pinkman was kind of similar, but it was already a pad split and they had them do some additional work to it. This is another one in a group of, 3 or 4 that they are doing this exact business plan. It looks like it might be the same seller, I believe. And so that's why they have a bunch in the same general area. I'm not going to talk a lot about the Mesa, Arizona market because, I've done that quite a bit. But I did want to just go into this, this zip code, the Zillow home price trends. They've gone down 3.7% over the last year. But Zillow thinks they're going to go up in the future. If you've watched my videos, this is a very common trend line that we've seen. But if you see here, it does look like we're a little tiny bit of an upswing. So hopefully that's the case. We've just seen this shape over and over again. So there's a lot of markets. Some of them don't have quite as pronounced of a peak and valley, but it's we've seen this over and over again. So I wanted to bring up this 3.7% down this year because one of the things I've constantly complained about is the valuations on these, right? And so the Roads, which is a larger property, 1 extra bedroom, we paid $600,000 for this one a year ago, just about a year ago. Home prices have gone down in the area. We're buying this one now with 1 less bedroom, right? So we're getting about 90% of the value, where it's actually, you're giving up about the same amount of square footage percentage-wise. But we're paying $585. So we're actually, on a relative basis, this is a worse deal than the Roads, right? We're getting like dollars per bedroom. It's a worse deal. The fact that the market has gotten cheaper, but we're paying more. I don't love that. I think I've complained over and over again about the valuations on a lot of these pad splits. We do, they actually addressed that a little bit in the webinar. They do get an appraisal contingency on all of these. And one of the things that that Joey meant, I think Joe, I'm not sure actually which one of them mentioned it, but that they mentioned the appraisers are, considering the fact that these are income producing properties, right? And that's part of what's going into these being worth more money than comparable homes when we're looking at it. And because of that, I'm not even going to dig into their comps because, as I've talked about a number of times, it looks like they're cherry picking them. They're not just taking, it looks like they're just pulling properties to sort of get to that valuation because they believe it's worth that, because you're able to get the income that you are. And I've gone back and forth on this idea quite a bit. I believe that, the market a certain portion of the market will value certain income properties more highly, like we've seen in certain markets. Short-term rentals got a big push, but at the end of the day, we own a single-family home, especially if we're in an area where there's zoning and it's just single-family zoning. it worries me to pay up for a specific business plan for that home because, one, as you can see, more and more of these are entering the market. So on the income side, we could see some erosion as far as demand goes, and so then some price competition. You saw that a lot as short-term rentals ramped up in many markets, and so I really don't like the idea of paying more for these properties than what I could sell them for as a single-family home, and that's just the decision that you have to make, like, if you're comfortable with that or not, right? Like, okay, let's say you can't, and we just have to hold this forever and operate it as a pad split forever. Well, that's okay as long as the 19 other investors don't see the same opportunity and start converting homes in this neighborhood in the same way until there's so many that the value, the rents that we're getting are so low. I believe that co-living and pad splits in general, or pad splits and co-living in general, are sort of where short-term rentals were, I don't know, maybe 3 or 4 or 5, 6 years ago. We're getting to the point where now pretty much every real estate investor I run into has heard of them. There's a lot of people, I like to, people say everyone and their mother knows about it. Well, I was actually talking to a guy at the poker table this weekend, and he was telling me that his mother was investing in co-living properties. I thought that was pretty funny. So it is, it's just some random person who saw my real estate guru hat, because I wear that everywhere, except for when I'm doing the Mogul videos, and then I put the Mogul hat on because they were nice enough to send me a free hat. Okay, I digress way too much. But so it is, it worries me that we're going to see, oversaturation at a certain point. I'm a huge fan of the business model. I think there's a ton of demand for it. I don't necessarily think, I'm not saying I believe that this is going to happen anytime soon, but because it's a risk, I'd like to see us not paying more for, than we need to for single family homes. And so looking at, estimates on some of the other sites, Realtor says 405. That's the estimate for this home. Redfin says 457. Zillow's estimate is 437. And again, we're paying 585, right? And so, okay, we're getting it fully furnished. And it's going to be freshly renovated. But, okay, so the highest one of these was what, 457? And we're paying an additional $130K over that almost. That seems tough, right? And the people selling it to us looks like they just bought it for $340, 2 months ago, and then they started their renovation. And so obviously they got it at a steal, right? There's somebody who's buying properties that need to be renovated. But the difference between, so it's $245,000 delta from what they paid to what we're being charged. I can't imagine this renovation is taking more than $100,000. I mean, I don't know how pricey the Mesa, Arizona market is, but if this were being done in my market, it's not $100,000 renovation, unless this property was absolutely trashed, which, maybe it was. But even let's say it's $150,000, we're still $80,000 shy, and you've got furnishings for pad splits are just not that much, right? We're just doing like bedrooms and very sparse furnishings. It's not like short-term rentals. We're trying to do high-end everything. So it's really hard for me to get from like, okay, why aren't we doing these deals, right? And I know, okay, well, there's a lot of work and some entrepreneurial risk involved. On the webinar, I think they actually mentioned they might start doing some deals like that. And maybe that's just what I need to get into, right? Maybe this turnkey where it feels to me like we're paying too much. Maybe it just doesn't make sense for my portfolio. Before I forget, please like and subscribe. In the description to this video, I have links to all the places where I'm currently investing in fractional real estate online, Mogul being one of them. Many of those will give you some free money for your first investment and whatnot. Make sure you do your own due diligence, understand the platform, what their terms are as far as those go, and the properties themselves. And also in the description of this video, I have a link set up to a Discord where we've got about 200 people that talk about fractional real estate investing on a regular basis across several different platforms. Feel free to jump in there. It's not a sales funnel. It doesn't cost anything. We're just having discussions about, whatever fractional real estate is interesting that day. There's a lot of people sharing info on deals that they've bought. Help a bunch of us jump in and do due diligence when new properties hit Mogul, and several other platforms. Anyway, back to this. So yeah, for me, this does not feel. It feels again like we're very much overpaying. At the same time, I've done really well with the roads, right? I told you, and it's only marginally more expensive per bedroom than the roads was. So, but when we go, I had the same concern about this one. I actually got half of my interest in this one for free because they were doing something where if you bought into the Axelrod for a certain amount, you got some bonus shares of the roads, and I really liked the Axelrod. What's pretty funny is the Axelrod has not been a great performer. The roads has, and so I mean that just goes to show I can't see the future. I'm not always going to be right about which ones do well and which ones don't. But so being in and let me show you the map, right? So this is, the Rudolph, extremely close to the bus line, across the street from a park. And actually great parking setup because you've got a couple of, you've got a decent sized driveway, but then you have street parking all along that park. So, and then in front of you too. So it's a good, it seems like street parking that should be plentiful. And when I was, doing the little street view, it looked that way. But and this is the roads right here. So you can say, it's only a 2-minute drive away. And so to have a comp like that, I think is really useful to be able to say, okay, we bought this property. This is what we paid for it. This is very similar. Yeah, this is, you can see that's the park. Did I move too far this way? I think this is our property, the Rudolph. This makes me a little bit nervous because I'm not sure whose parking this is, right? Does this belong to this home? Because it's kind of right in the middle, but we at least, I think, have this much and here. I don't know. But even if it's just two parking spots there, 2 more street parking spots there. Oh, where's this? Yeah, we can park on that side of the street. It looks to me. But definitely on this side, it looks like you can. And so you've got all of this, because this is all a park, you've just got tons of real estate there to be able to park in. Let's see, we got rid of that. I'm going to close some tabs because I've got too many open. This was I was just looking to get a sense of, where it is overall. Well, let's see, let me close that one too. And close that one. FEMA flood map. All of these, this whole area, although I just did notice, okay, maybe we get out of, there is some that's not in the shaded X. But again, we're in the shaded X flood zone here. I've talked about this a whole bunch when I've looked at different properties in this general area. It's something you just have to decide, like, is that a risk level you're comfortable with? Obviously, the guys at Mogul are on top of, the insurance as far as they always talk about, if they need flood insurance, they get it, all those sorts of things. Let's see. The crime map I didn't love. So we've got, but again, I've got the roads in this area and it's doing perfectly fine. But we have a gunshot here. When I pulled this up before, there was one down here, but I think maybe it's aged out now. But when you zoom right in, okay, maybe it's not so bad in the immediate area, but you do have a lot of assaults and, some violent crime in the area, which I never love. I don't like to see that. That's probably the worst issue. But, it's not the worst crime map that we've seen, especially when you start to zoom in. But, I mean, this isn't that far off, so I don't know. And then, so I always look at I've started looking at this neighborhood scout map as well. And I think that we're in this U2 neighborhood, this section here. So it's not the absolute most dangerous, right? It's not the darkest ones. And I actually don't think it's the second darkest. I think we're in the third. So, a little bit safer than the area in general. And I think when you're looking at that spot crime map, it might be pulling some right there too. I don't know. So I think for the pad split business model, it's something I've come to expect, right? In general, they're in areas that tend to, not be the safest parts of town, because it is some of the cheapest, it's the lowest cost of housing that you can find, right? Renting a single bedroom. Anyway, that's all about that. So one of the things, though, that I wanted to share, because I thought this is some info that maybe not everybody is going to have access to. I was looking at the roads and I was trying to figure out. So, sometimes I look at we don't have any past performance on this property, right? Because it's being renovated. And so I wanted to look at, okay, if we took the roads and, it's 90% of the roads because it's 9 bedrooms instead of 10, how does that compare to what they're assuming here, right? And so what I did, because I own the roads, I dropped off this month because I think this was not a full month of ownership. And I just took the average monthly income, top line income that we've had. So I took that, I averaged it. The average is $7,400 a month, and that even includes November, which is their worst month so far. They did have a dip in occupancy, but said that it should be full again, or it's already full again going into December. But so that averages $7,410 a month. Multiplied that by 12, and then multiplied it by 90% because we only have 9 bedrooms instead of 10. Because what I'm trying to do is say, okay, if we can perform exactly as well as the roads per bedroom, how are we going to do? And that gets us to $80,000 in top line revenue, and they're projecting $76,800. I think this makes it, one, they're going to have a little ramp up period, although there's some of that's going to happen with the current owner. So I think, but then if you look at the next, you've got to get to year 3 before they're passing that, right? So I think that's good. In a certain way, they're being conservative again with their projections on the income side, at least in my opinion, right? On the flip side, though, now, okay, does it make sense to think that we're not going to erode any of the demand that's going into the roads, right? Like, are we doubling the number of pad splits or the number of bedrooms for rent in that neighborhood? I'm not really sure what the answer is to that, right? It's tough to know, because it is a newer model. It's really tough to know how much actual demand there is for this, and at what point we're going to see too much supply in certain areas. So I like that we're so close to this other property that they're already operating, because it's a really good comp, right? Both the purchase price comp, like, okay, we're not too far off. We are paying for it more than we were the other, but it's pretty close. Paying more per bedroom, right? And we can look at, okay, these are we can look at their revenue comps and have a much better, be much more confident in that number. And so from that perspective, I think it's good. But on the flip side, well, okay, now we're competing with ourselves there too, right? And I just have no sense whatsoever on how much actual demand there are for individual bedroom rentals. And, to be perfectly frank, I don't think that anybody really does. I'm sure Padsplit has a general idea, because they've now entered several different markets, but each market behaves a little bit differently. As far as, like, I remember when they first started talking about San Antonio, they had some different expectations, I think, than how it's really turned out here. And you can see certain parts of town, we've added tons of rooms and they seem to have getting used pretty well. Other parts of town, maybe not so much. And it is, it has to do with what the other housing supply looks like, right? Is there other ways that someone can live extremely cheaply, that's competing with this room rental? So I don't know. I'm kind of on the fence. I don't think that I'm going to invest in this one. One, because, even though it is right by a property that's doing very well for me, it sort of goes against the trying to get a diversified portfolio on here. I do also because we haven't seen one of these get completed yet, where they where this seller is renovating it, launching it, furnishing it. It's really tough to know, okay, how good that's going to work out, right? And if I were going to buy one of these, this would probably be the one I'd buy, because I do think being right next to the roads makes it the easiest to make a projection for. I've still just been being very cautious on here. I ramped up to the 15 properties I have pretty quickly. And this was a down month. I'd like to see what happens next month, see how, almost not across the board, but for a lot of properties, the roads included, which is the one that's near here. And then they also talked about they've got a multifamily one coming up. Probably going to invest in that one if it's a deal whatsoever, because I'm a big multifamily fan. They also talked about maybe they're going to buy some that they'll be buying it earlier in the process, so maybe we'll get a little bit better deal that way. And yes, it's a higher risk level, but I think I'm okay with that. So I don't know. I think I'm still going to hold off on this one. It is the most tempting of this recent group of pad splits in Arizona. But it is, I just have such a hard time wanting to pay, $245,000 more, or, somewhere around there, $245,000 more than what they paid for it. It just seems like we could do a whole lot with a property, with that amount of money. It just seems like obviously somebody else is taking that risk, so they need to get rewarded for it, but it seems like too much, right? I think, and it worries me that if we can't use this as a pad split and had to sell it, that we're just not going to get close to that out of it. It just, that's how it feels. I don't know, I don't know what the real answer is, but that's the, it's just that risk. All yield is temporary, basis is forever, right? And I just don't want to have this inflated basis that's built on a specific business plan that I'm just not sure is going to, going to continue for the whole holding period for this property. Anyway, that's all I've got to say about that. Kind of the same video I've made like 4 times now about these. I really do want to be excited about one and jump in and buy one. And it's been a long time now since I bought a property on Mogul. I know a couple of people mentioned they were disappointed in the way that they sort of reported this month, because a lot of people had disappointing months compared to other months. I've always thought that their marketing was a little bit aggressive, a little bit more spin than I'd like to see. And so it doesn't really surprise me that they're trying to, keep it positive and whatnot. At the same time, I really just expect it, right? Especially short-term rentals, you're always going to have bad periods of time. I was a little bit surprised about the pad splits, but when they mentioned that because of the way, weekly rental rates, the times that it's being paid out, the way they fall, that made November a little bit worse, even for ones that were fully occupied. I thought that was kind of interesting. And I guess that's going to happen probably twice a year. Is that true? Maybe not. But the way, I thought that because of how paychecks work, right? If you get biweekly paychecks twice a year, you get the extra one in a month. But maybe that's not how it's going to be, because it's actual weekly. But it depends on their pay date where that falls. So anyway, I'm not too worried about the way that they've handled it, but it'll be interesting to see what happens next month, right? If we continue to see a downward trend, then obviously I'm going to get very nervous. But at the moment, I'm still cautiously optimistic. And if this had been a more exciting deal for me, I would have jumped into it. Oh, I didn't even mention 8.1% is what they're projecting is for the year one yield. It's not the most exciting year one yield they've presented. They did mention they've just tried to get a little bit more conservative with their projections, and also that they, now that they just have more data, they have a better idea of where those are going to end up with these pad splits. It is what it is. It's not. I'd like to buy at the same time, right? 8.1%. Not very excited, but if you think about the properties I'm buying on Arc 7, the properties that are on Arrive, the properties that are on Real Bricks, we're still significant. 8 is still significantly higher than the average on any of those other ones, right? And so sort of they're being punished for the higher yield ones they've had at other times. Although a lot of the real high yield ones I passed on because they were the pad splits that I just didn't love the bases. So I don't know. Maybe I'm just becoming a grumpy old man and am not going to be able to find another one I'm happy with. Hopefully that's not the case. And now I'm rambling way too much. It is almost 3:30 in the morning, so sometimes that happens. Anyway, until next time, I'm just going to keep making mistakes so that you don't have to.